Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, welcome to the show. It's great to have you here. One of my goals with CMQ Investing is to help investors like you and me do better than the average investor simply by making less mistakes than the average investor. In this episode of Compound Money Quietly, you will learn about a very costly mistake that investors have been making for decades. I'll let some of the greatest investing minds of all time tell you a little bit more. The late John Bogle said that the biggest mistake investors make is looking backward at performance and thinking it'll recur in the future. Ray Dalio agrees. Dalio says that the biggest mistake investors make is to believe that what happened in the recent past is likely to persist. He goes on to say that investors assume that something that was a good investment in the recent past is still a good investment. But typically, high past returns simply imply that an asset has become more expensive, not a better investment. Benjamin Graham once said that the ability to buy stocks successfully is the ability to look ahead accurately, and looking backward, however carefully, will not suffice and may do more harm than good. Benjamin Graham's most famous student, Warren Buffett, said that if history books were the key to riches, the Forbes 400 would consist of librarians. Warren Buffett also said, and I quote, "You don't get paid for what's already happened. You only get paid for what's going to happen in the future. And sometimes, the past doesn't give you any insights into the future." In his latest column in the Wall Street Journal, Jason Zweig offers some new evidence as to why investors continue to try to use the past to predict the future. I'm going to read you a portion of this column. It's titled, "Why Investors Can't Kick the Past Performance Habit." Let's get into it. The following portion of this column begins about halfway in. Jason Zweig writes, and I quote, "Investors might be forgiven if they momentarily forgot that the past never repeats itself exactly. It's a tough habit to break. We live in a world in which skill and excellence often persist, and price is generally a good signal of quality. Great athletes with a hot hand seem to score again and again. Your favorite restaurant's food should be as tasty today as it was last month. A luxury car typically drives better than a cheap compact. And there's some truth to it in the markets too. Stocks whose earnings and prices have recently been rising tend to keep winning, while those that have lately been losers often keep losing. But the stock market is a complex, dynamic system that doesn't follow the rules of restaurants or cars. Investing is so competitive that history can rarely repeat for long. If any past pattern reliably recurred, so many people would pounce on it that it would soon stop working. Indeed, when the winners keep winning patterns reverse, they can deliver devastating losses. The human habit of pretending that a rearview mirror is a crystal ball is almost incorrigible. Investors like seemingly coherent explanations of market moves, such as those the news media provides. As soon as the market stops going up, those explanations, no matter how arbitrary, tend to make the new down world seem more likely to persist. Finance professor Meyer Statman of Santa Clara University analyzed more than a decade's worth of monthly surveys of individual investors. The proportion who expected stocks to go up over the coming 6 months rose, on average, by 1 percentage point with every percentage point increase in the S&P 500's returns for the prior month. It's as if investors believe the medium-term future is shaped by the short-term past. Trying to get people to stop that behavior can backfire. In a new study in the Journal of Experimental Psychology Applied, behavioral scientists Peter Aden and Leonardo Weiss-Cohen of the University of Leeds and Philip Newall of Central Queensland University tested disclaimers about past investment performance on 1,600 people in the United States. Roughly 1,000 had at least some investing experience. In 60 rounds of this experiment, the participants chose between Fund A and Fund B. Each time, they saw each fund's fees and its gains or loss over the prior month. Those returns varied randomly, but on average, Fund A would outperform over time because its fees were much lower. Strikingly, when many investors viewed the standard mutual fund disclaimer that past performance does not guarantee future results, they chose the fund with higher fees more often. A lot of experienced investors seem to believe that the warning won't apply to them, says Mr. Weiss-Cohen. It's maybe like they think, I can make it work because I know better. The phrase does not guarantee future results may cause investors to conclude, erroneously, that past performance is nonetheless a highly reliable indicator, says Mr. Newell. Low fees are a much better indicator of future outcomes than past returns are. What does discourage investors from chasing historical returns, the researchers showed, is a warning that reads, and I quote, "Some people invest based on past performance, but funds with low fees have the highest future results." That apparently prompts investors to make a social comparison between themselves and others. Who wants to settle for investing like some people? Everybody wants to get ahead of the Joneses, says Mr. Newell. So, as you watch the market on its latest wild goose chase after past performance, remember, some people invest like that. You don't have to. What we discussed in this episode will be particularly relevant to our next episode. It's about thematic ETFs. I don't want to spoil it, but yes, you should know what we just discussed and really internalize it, not only so you can get more out of our next episode, but so you can avoid making that costly mistake. I want to leave you with one of the key takeaways from a report that was prepared by the Federal Research Division for the Library of Congress under an interagency agreement with the Securities and Exchange Commission. I know it's a lot, but it comes from 2010. It's titled Behavioral Patterns and Pitfalls of U.S. Investors. Tell me if this doesn't sound familiar. It reads, and I quote, "Behavioral finance holds that investors tend to fall into predictable patterns of destructive behavior. In other words, they make the same mistakes repeatedly. The mistake of using the recent past as a crystal ball to try and predict the future can cause you to make costly mistakes that ultimately interrupt the compounding process. That is the opposite of what we want to do, and will almost certainly ensure that we don't do better than the average investor over the long term." And as I said, I hope this episode helps you internalize this so you avoid making this mistake altogether. I also want to make sure I let you know that Connor, the overconfident investor, is recovering and he's going to make it. He's in the hospital right now. If you listened to episode 19 at the very end, you heard, well, he had a horrible accident.
Nonsense. We ride Lambos around here, baby.
Connor, if you're listening, we love you, man. We're thinking of you, and we can't wait to have you back. If you're listening to this episode on Apple or Spotify, make sure you subscribe so you never miss an update. And if you're on Apple, it'd be great if you could leave a 5-star rating and a short written review. If you're one of the many CMQ investors who've already done this, I just want to say thank you again. We really do appreciate it. This has been Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.